Hello, welcome to the Acrostics Asia podcast, connecting the dots across Asian credit. I'm Milbank LLP, founder of Acrostics Asia, and we have Jacqueline Chan, partner at Milbank. And the topic today is Asia private capital. It's a pretty hot topic. It's been discussed a lot. So this time we're going to try a slightly different format, which is 12 questions. And the first two questions will be warm-up questions, and the rest will be on private capital. Okay, ready?
Sounds good. Hi, Evelyn. How
Okay,
are you doing?
thank
Let's
you.
go.
Okay, so first question is, what's the first thing you read in the morning that's not your email?
It's Unfortunately, I have a really bad habit of looking at my emails first thing in the morning, but I think straight after that, it would be probably the Financial Times on an app on my mobile phone, or maybe Bloomberg. I really like trying to get a little bit of up to speed at the early start of the day, seeing what happened overnight. You're really trying to understand if there are any big global macro shifts overnight, or whether there are any overnight movements in deal activity or Wall Street activity, and any updates coming out of the major capital cities in the world. So I think it's just sets me in a good state of mind to sort of think about what might be the topic of the day or the key trend of the day, before the day really starts.
All right, so the second question is, how do you like your coffee and where do you get it?
Oh, I need coffee in the morning. So I really like black coffee. My office is at Marina Bay Financial Center, so I usually just hop down to one of the really good espresso spots right downstairs. And in this job, like coffee is just a non-negotiable start to the morning.
Same, same. Okay, so now let's go to the state of play.
Mhm.
How will you describe the mood in Asia private capital right now?
I would describe the mood in Asia private capital right now as being something like pragmatic impatience. So, in that sense, I think what we are seeing right now is that the era of easy growth and sky high valuations is pretty much behind us. But there's still a huge amount of dry powder in the region that just can't wait forever. So, there's a lot of intense pressure on GPs to return capital, and the mood isn't pessimistic, but it is very disciplined. So I think what we're seeing now is that buyers in the region are really digging deep into operational realities as of the day. And that obviously gets adjusted depending on the geopolitics of the day that happens. And I think what we're also seeing is that sellers are readjusting to the new valuation baselines. So I think it's pragmatic impatience in the sense that people are starting to really try and come to grips about what the region actually represents and how to get deals done. But it's a grinding, highly sophisticated market right now.
Hmm, thanks. Next question. Which exit window will open first? IPO, strategic sale, or sale to another PE fund?
My money is on strategic sales, followed closely by sponsor, so PE to PE sales. And I think the only reason for that is because I think IPO markets across the region still remain very selective and very dependent on specific sectors, like whether it's digital infrastructure or something like that. Strategics at the moment are, I think, to the large extent in comparison, cash rich, and they are looking for defensive consolidation. And so secondary buyouts are being driven by those private equity funds that must deploy capital, and they are finding creative ways to structure deals across valuation gaps.
Okay, so private credit has been booming in Asia. What's the bigger story, the opportunity or the risk?
Mm, it's a good question. I actually think it's a tight race, but I think opportunity is winning simply because of how flexible private credit is. I think what we're seeing is that traditional banks are tightening their lending criteria, and so therefore private credit has this opportunity to step up to fill this massive liquidity gap for mid-market and structured mid-cap financing. So but I would say that as someone who sees quite a lot of the insolvency and restructuring side of the market as well, the flip side is that the risk associated with the current market is real. Maybe of the many of these bespoke and heavily structured facilities haven't quite yet been tested throughout a full credit cycle yet. So the real story is going to be to see how these private credit funds really handle workouts and restructurings when underlying assets underperform.
Mm, thanks. So now let's take a tour around the region. Japan has been a standout market so far. Do you think there's more runway left, or it's too late to join the game now?
Oh, definitely much more runway. I think Japan's corporate governance reforms at the moment are structural and not cyclical. So the pressure on conglomerates to carve out non-core businesses and improve capital efficiency is creating a steady pipeline of high quality, large scale carve outs. And coupled with the weaker yen and relatively favorable financing conditions compared to the US or Europe, I think you would see that Japan's going to remain a core pillar for any serious Asia focused fund.
Okay, so next is China. China was called uninvestable a couple of years ago. So do you think that was fair or unfair?
I think it was unfair. I think uninvestable is probably just a lazier word for saying it was just really complicated. And China's was complicated and could still be depending on how you come at it. The reality is that I think what's happening in China is that the investment thesis has fundamentally shifted. I think the old playbook that I think international funds were looking at of backing either pre-revenue tech growth or real estate plays is gone. And instead, the focus is now shifting to domestic consumption, advanced manufacturing, and companies really invested into decoupled supply chains. So it requires a much more surgical and localized approach. But the sheer size of the economy means that the opportunity never really disappeared, but instead it's just shifted. But it requires much more. I think it requires a very different mindset in terms of finding those opportunities and finding ways to finance that. But I think China is definitely still is and will continue to be a huge market for the rest of the world.
Thanks for that. India, overhyped or justified?
I think it's definitely justified. I think the key thing in India is always going to be, execution is going to be the key driver. So the macro in India, the tailwinds are just undeniable, right? I mean, the demographics, the digital infrastructure, the global supply chain relocation, it's just all there and all firing on all cylinders. So the challenge isn't really finding growth, it's really navigating the frameworks for regulatory and tax, managing the high entry valuations, and also ensuring the clear exit pathways. And so what I think is really important is local expertise in India, as well as significant deal execution experience and patience. And I think the returns in India will be undeniably real.
Mm. So last region, if you had $1 billion to invest in Southeast Asia, where will it be?
If I had $1 billion to invest in Southeast Asia, that's also a good dream to have. But if I had $1 billion to invest in Southeast Asia, I think it would have to go into digital infrastructure and energy transition across ASEAN, with a heavy emphasis on Indonesia and Malaysia. And the
Mm.
reason for that is because there's this explosion going on right now of artificial intelligence, of cloud computing, of data localization demands that makes data centers, fiber networks, telecom towers the ultimate defensive growth play. I firmly believe that that is an incredible investment opportunity that will not go away for the longer term. And I would pair that together with the logistics and clean energy infrastructure that needs to support the regional supply chain migration. And to me, that's just a good investment thesis and a great investment thesis for today.
Okay, cool. So next question will be on deal structure. It's a bit technical, but should still be fun.
Only for lawyers like myself, I guess. I love
For
these
me
sort
as
of
well.
questions.
Um, so what are the deal terms or structure that you've been negotiating most this year that barely came up 5 years ago?
So what we see today versus 5 years ago are just highly structured equity and credit hybrids. We call them hybrid equity, structured equity. They've got many different names, but that's currently been something that we see in almost like a majority to most deals at this point in time. So 5 years ago, cheap debt meant that, straightforward leveraged buyouts were everywhere, and it was the easiest way to ensure that equity returns were guaranteed, that you could basically offload some of the debt using these straightforward debt instruments. But what we're seeing nowadays is that we're constantly structuring complex mezzanine layers, whether payment in kind toggles or preferred equity instruments, to close the valuation gaps between buyers and sellers. The other thing that I think we are seeing a lot more today than we did 5 years ago is a massive uptick in structured secondary solutions, such as, whether it's continuation funds or sophisticated warranty and indemnity insurance wrappers, which are applied to distressed or accelerated M&A to strip out execution risk. So I think those two are definitely, it leads to greater sophistication in deal execution and deal terms. And I think that's something that we see the market really grow into over the last 5 years.
Okay, so the last category is on trends. What do you think is the most overrated and underrated trend right now?
I think as a lawyer, I'm not sure I'm the best to answer this, but let me give it a shot. So I think the overrated trends, and this came from a conversation I was just having with an advisor just today. The current overrated trend, it might be, just calling everything AI
Mm,
integration.
mm,
So we're seeing a lot of, maybe opportunities of companies calling themselves AI, which is just a very thin layer of tech on
mm.
top of just a traditional business model, and just saying that drives a lot of value. But I think we can see that just slapping an AI label on a company doesn't really fix, any issues with margins or poor capital structure. So I think that's an overrated trend, this, calling everything AI. I mean, we've seen this before. The previous cycle was crypto. The previous cycle before that, 20 odd years ago, was anything called .com. I think
Mm.
we're just seeing another fad of this go through. Um, Underrated, and this is a bit of a pet peeve for me, underrated would be the velocity of cross-border distressed M&A deals. To me, where we are today, there is a perfect opportunity to find, high quality assets that require recapitalization or operational turnaround. And there's an incredible playbook for sponsors who know how to navigate both insolvency and restructuring regulatory issues, as well as coming up with creative capital solutions and finding these assets, and really, turning them around for the longer term. I think that's an underrated trend that I really hope gets more onto the mainstream, because those deals are difficult, they're complex, but I think in the longer term, they're incredibly rewarding.
Cool. So the last question is even more crystal ball in nature, but I'll just ask it anyway. What do you think will be the best deal of the decade?
Hmm. Best deal of the decade. That's a really hard one, because I don't have a crystal ball. And if I had a crystal ball, I definitely want to be on that deal. But my sense about the best deal of the decade, it won't be a flashy multi-billion dollar tech IPO like, a la SpaceX or anything like that. I think the best deal of the decade is going to be the successful consolidation and scaling of regional digital infrastructure assets. I think that actually is a great playbook at this point in time. Whether that's data centers and renewable energy platforms, that if you can scale that together and consolidate that together to capture the entire ASEAN growth story under one unified institutionalized platform, I think the sponsors that build that platform out early will see an extraordinary long-term defensive yield.
All right, that's 12 questions of Jacqueline Chan. Thanks, Jacqueline, for your answers. And to our
No,
listeners, thanks for listening. I hope you enjoyed it, and watch out for more podcasts from Acrostics Asia. Thanks. Bye.
bye.